Intellectual stew. Intellectual stew with James Kirkland.
Powerful and provocative, prophetic and practical,
Intellectual stew.
informative and inspirational. How you gonna do better if you don't know what better looks like? I do.
Intellectual stew.
Come on, let's talk about it with me, the mind massager.
Intellectual stew with James.
Hey, what's up? What's up? What's up? What's going on? Hey, Chris, how you doing?
How are you?
All right, I saw you when you popped in. I was trying to give them playing the music, giving them a little more time to come in, and I can also share this thread with a couple of different groups. Everything good with you though? How's your
Yeah.
week been so far?
No, it's been great. Hey, I can do an Equus background if you let me change it. Let's go to settings.
Go ahead, do
Virtual
it.
background. Let's do
You
it.
like that? You like that? You like how I did that?
Yeah, I
You
do. But for whatever reason, there we are. Oh,
I
it's not
thought I would
letting
do one.
me
Need to represent my company. Hold on. I know I need to represent my company, so I said, let me change my background. I changed the intellectual stew to Equus Financial.
Well,
But those of y'all that are in the chat, do me a favor right quick. Go ahead and share this and let people know um, that we're on. We're gonna be talking with Chris Tinsman probably for about 30 minutes or so, and um, and then we'll move on. But she's gonna answer some questions about life insurance and tell you how to properly apply it to your life. We had a show a couple of weeks ago, and we got some pretty good reviews and got some good traction on that show. So I wanted to she wanted to come back again today, and she wanted to share with you all, help us better understand life insurance, so we can be use it more effectively in our lives. Chris. So many of us are under the misconception that life insurance is only for death purposes, or just to pay. That they're gonna get rich or whatever off of a life, as far as being a beneficiary of a life insurance policy, and
sure.
I wanted you to come today and correct some of those myths. Do me a favor, for those that might not know who you are, go ahead and give us your background once again, as it relates to life insurance.
Okay, so I've been doing this for about 14 years. And we were on a couple weeks ago. I think it's been 2 weeks now. Is that right?
Something like that.
Okay.
I think that's about right.
And I graduated from Elon University. I was a semi-professional soccer player in Baltimore, Maryland. I played for the Baltimore Lady Bays. And let's see, I was in corporate America for about 16 years. And I
Mm-hmm.
got sick and tired of making everybody else rich. And I figured if I was going to work for myself, I was going to do something that was going to change people's lives. And I've been with insurance for about 14 years now. And I love
14
what
years.
I do.
You love what's so gratifying about it? What that makes you love insurance so much?
Because I know, like, so if you know, think about the average insurance agent is in and out of the industry in a year to 2 years because they
Mm-hmm.
can't make it. And the
Okay.
reason they can't make it is because they don't love it
Okay.
and they don't care about their client. The
Mm-hmm.
thing that's so gratifying about what we do is that I know that if you purchase a life policy, whether it be a term policy, a retirement policy, or a permanent policy, that
Mm-hmm.
it can and will change the dynamic of your life. I've never had anybody send a check back.
Okay. Yeah. You know, you have an aha moment. You know, you hear something in pass and it kind of touched me on the back of my head. I'm like, whoa, okay, I hear what you said. Nobody, I don't think anybody ever has turned it. I couldn't imagine anybody returning a check. And you said something last time, and we're gonna get into the semantics in a minute. But you said something that I think everybody needs to hear, and I want you to say it again. You think it's everybody's responsibility to do what? What was that you said? And so,
I said that I believe that it's everybody's responsibility that once they have a job, I believe it is your responsibility as an adult to not leave the burden of putting yourself in the ground or doing cremation to your family.
mm, that,
Again, we go back to the GoFundMe, and I will
yes.
tell you a little story. Yesterday, I was sitting with a 65-year-old male here in Richmond, super
Hmm.
nice guy. And here's exactly what he said to me. He said, I do not want to be paraded on Facebook with
Wow.
a GoFundMe report. I want my children to have enough money to do what they need to do. And
Wow.
I almost jumped up and hugged him.
Wow. You know, when one time you had me do a pink letter campaign,
Yep.
And I sent, pink letter campaign for those that don't know it. You buy a bunch of address leads, older leads, and you put them you copy them on pink paper and you mail them to people's houses, and you get them to respond to insurance. So these, I sent them out, and people started to respond. And one lady called me, and she thought I was the insurance company. She didn't think I was an agent, and uh, and ironically, she didn't have insurance on her boyfriend, and the boyfriend had just passed away, and they were living in a home together. Everything was in his name, and so she was 3 weeks too late. If I had called her a month and a half sooner, because he was helping me relatively healthy, I think it was a sudden incident, and he passed away, and she didn't have coverage. So, and he didn't make provisions to make sure that his family was taken care of in the event of death. Because one thing about it is, it's appointed unto man. That's scripture. It's appointed unto man wants to die. And death is a promise of life. So at some
Yep.
point we are going to experience it. The thing is to be prepared and make sure that we take care of our family. So what I want to do, and I got a few people in the chat. I want you, if you have any questions, feel free to put those in the comments. But also share this thread. We're not going to be on very long. Like I said, we're just going to share. You're going to hit some points right quick because I got an appointment at 2:15. I got to write a policy, so I got something I got to do anyway. But I do. Are you proud of me?
Yes.
Okay, good. All right, good. All right. So what we're gonna do is we're gonna kind of recap what we talked about last time, and
Yep.
then we'll expand on it a little bit more. The first, we have two different types, pretty much, of insurance people. There are permanent insurance, and there is temporary. I said there is permanent insurance, and there is temporary insurance. First, Chris, explain to us what the temporary insurance is.
Okay, so temporary insurance, and do you want to go? Are you going to put anything across the bottom or anything, or you just want me to just use the bullet points that we talked about?
I mean, I'll probably be adding stuff as you talk. I'll, I'll,
Okay.
I'll put some stuff on there as you go. So yeah,
Okay, so
yeah.
here's what I like, and the reason that I want to talk about this is because I think that it's actually important that we discuss the important keys to term insurance. Term insurance is temporary; it's for a period of time, meaning 10 years, 15 years, 20 years, 25, or 30.
Hmm.
Normally, a term insurance policy never goes beyond 30 years. So if you see at the top of your policy that it says term to 85, that doesn't necessarily mean that the premium's going to stay the same. That just means that you can keep it to 85, but most of the insurance that you buy through the mail goes up every 5 years or is 1 year annual renewable, meaning it goes up every year or every 5 years.
Okay. All right, so
Okay.
that's key. So and here that people don't know I'm online, but that's fine. We I guess I gotta let everybody know my schedule. But so term listen, people. Term insurance is just what it says. It is for a period of time. It's for a period. Hear me when I say that again. It is for a period of time. I'm putting it on the screen. It's for a period of time. Oops, I ain't what I'm here it is. A period of time. 10 years, 15 years, 20 years, 25 years, 30 years. So it's for a period of time. So tell me something, Chris. When is the best time to have the term type of insurance?
Okay. So the best time to have term insurance is
Mhm.
when you are young, you have a bunch of debt, and you have your family.
Okay.
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 Now you're going to
Mhm.
ask me why, right?
Yeah. Well, that was the move. But since you taking the words out of my mouth, go ahead.
All right. So why? Because that's when you have your largest form of debt.
Okay.
And when you die at a young age, it's more impactful and devastating than after you pay off a lot of your debt in your older years.
Okay. That makes a whole lot of sense. So when you're young, that mean and for let's talk how it's intended to be. Young families,
Yep.
28 to 28 to 33, 34, whatever it is.
Mhm.
Kids are coming on the scene now. Just getting a mortgage, getting
Mhm.
a car note, trying to establish yourself. You're in your careers, but you're not deep enough in your careers where you're able to save any money. So now you're able to get temporary insurance, which is term insurance, and you're able to explain this for me. You're able to get the larger denominations of
Mhm.
insurance
Yep.
because and we'll go into whole life in a little while, but explain to them why we're able to get the larger, like the 100,000s and the 200,000s and all those types of numbers
Okay.
in that age range, in that younger age range.
Okay. So you're basically that's when you incur your most debt. You got a family, you got a mortgage, you got car notes, you got credit card debt, whatever.
Hmm.
Again, you're establishing yourself. The reason that we can get more insurance for a lower cost is because we're younger and we're healthier, and the risk for the carrier or the insurance carrier is not as great.
Okay. Okay. Because you're healthier now.
Mhm.
You haven't developed the diabetes of life. You haven't had your first heart attack, all those things. So the likelihood of mortality is very low. So
Mhm.
therefore you're able to buy more insurance at a very reduced rate, I guess, if that's the best way. Is that a
Yep.
good way of saying it?
Yep, you
Okay.
get more insurance for a smaller cost
Hmm.
because the risk that something's going to happen to you is smaller.
Okay, so that's going to be our temporary insurance now, and with the temporary insurance, what we sell or what we provide, also comes with something called living benefits.
That's
Correct,
correct. That's
because most people believe that insurance only pays when you die. Hold on one second. I want to show this little video right quick, and then we'll come back and say I'm gonna surprise you. I'm gonna make you proud of me today. Watch this.
Comes to mind. Most might think of money accessible to loved ones only after you kick the bucket. But what if we told you there's a new kind of life insurance? One far more useful than the old kind of life insurance. One that can be utilized while you're still living. It's not too good to be true. It's called living benefits. Medicine and medical technology have evolved significantly, allowing those who suffer from a chronic, critical, or terminal illness an ever-increasing chance of survival. Unfortunately, medical costs associated with suffering these illnesses have increased as well. Consider this. Approximately every 40 seconds, an American will suffer a heart attack. 90% of those Americans will survive that attack. Now consider that 2/3, 66% of all American bankruptcies are the direct result of a critical illness, such as heart attack, and the medical expenses that follow. Something's not right here, folks. Worry not. Living Benefits is here to make things right again by allowing you to accelerate your death benefit after enduring a major health event. Living Benefits help to cover your medical bills, deductibles, co-pays, and experimental treatments, and can even replace your lost income during recovery. If that doesn't convince you of the incredible power of Living Benefits, perhaps this will. The new kind of insurance costs the same as your old kind of insurance. Equus Financial understands the importance of living benefits and wants to ensure you can protect yourself, your family, and your peace of mind. If you're interested in learning more, contact an Equus agent today. Don't leave your well-being up to...
All right. So explain to us what we just heard, if you don't mind.
Okay. So living benefits are this: chronic, critical, and terminal illness. Chronic illness being that you cannot perform 2 of your 6 daily living activities: dressing, bathing, eating, toileting, and transferring. The actual policy will pay you 24% of the face amount of the policy. So example, you go into the hospital with COVID and you're there for 4 months, and it's 90-day period that you are sick. They will pay you 24% of the face amount of the policy. If you had a $100,000 face amount, they would pay you $24,000 in a lump sum, which makes it better than an Aflac policy, because Aflac's going to pay you daily and they might only pay you $30. And how much or how many days do you have to be out to get that $24,000 amount?
Wow. So that's a chronic, right? Which one is
Chronic.
it? Okay. Then we also have the other two. What is the other one? Critical?
Terminal illness is
Okay.
going to be in the event that you are diagnosed with a terminal illness and death is imminent by a doctor within the next 24 months. And it doesn't matter if you live past the 24 months, they will accelerate 100% of the face amount of the policy to you so that you can get all of your affairs in order and spend the time with your family that you should be spending with them without the anxiety of debt.
Wow. And then the other one, the final one is
Critical.
critical. Okay.
Yep. Critical illness, examples: heart attack, stroke, ALS, cancer, kidney failure, blindness due to diabetes, any type of organ transplant. They will pay up to 100%, but there is an item that you need to understand about that. Remember, these are critical illnesses. These are illnesses that are going to keep you out of work. This is not a knee replacement. This is not a hip replacement. This is not a broken arm. Okay. These are major medical events, and it is based on your remaining life expectancy. So, for example, if you had a heart attack and you damaged 40% of your heart, then your remaining life expectancy would have decreased by that same 40%. So if you had a $100,000 policy, they would cut you a check for $40,000.
Wow.
And if you were out of work for 9 months, that would help you not fall behind on medical bills.
Absolutely.
And not fall behind on your mortgage.
Got you. So that's the key component, folks.
Mhm.
These policies offer living benefits. You don't have to pass away to get those benefits. How many times have you seen someone who's had a major medical mishap or something happened to them, and then they fall in debt, and then they're just waiting to pass away or whatnot? Now, if they had this type of policy, they would be advanced money. And that one about Chris about the COVID.
Yeah.
That's amazing. So if they're in the hospital for 4 months, is that what you said?
Yeah.
Then they can if they had $100,000 policy, they
Mhm.
would be advanced 24% of that policy in one lump sum. So, I mean, that's $24,000 divided by 4 months. That's $6,000 a month.
Yep.
While you're out in one lump sum.
Yep.
If something, God forbid, it were to happen, but if you were to contract an illness that's not even deathly, that's one that you survived, and it still paid you while you were yet still in your life cycle. That's amazing. That's amazing. All right, so that's the terminal insurance and the temporary insurance, which is term policy. And we say that our policies also offer living benefits. Now, another component of our policies also are the medical questions, correct? You only have to answer medical questions. You don't have to do.
You do not have to do blood work, and you do not have to do urine up to a certain amount of coverage.
Okay. Okay. And that's a lot of people like that. They don't want to give their blood away for whatever reason. But all right. So that's temporary insurance. But let's talk about permanent insurance. Give us the different types of permanent insurance.
Okay, so we've got two types of permanent insurance. Okay, there's one that we call the indexed universal life, which
Okay.
if it's funded properly, you can use it as a retirement plan because it has a compound interest component and a tax-free payout.
Okay.
And then there's whole life, which is guaranteed and governed by the United States government. It will only grow at 2%. Okay. So it's not going to accumulate a ton of cash value, but it is guaranteed to pay out because the premium is locked in for your entire life. And those policies go up to age 121.
The premium is locked in for your entire life. So if you're paying $50 a month, that never changes. That's going to be consistent. So the difference between go ahead.
And the face amount of the policy does not decrease over time either.
Absolutely. And the difference between that and term, and that's what I want people to understand. If you got a little policy where you're paying $30 a month for $100,000 of policies and you're 25 now and you got a 30-year policy, 25 plus 30, that's 55. At 55, if you've not put anything else in place, you're going to have to get a new policy. And at that point, they're going to rate you as a 55-year-old, not a 25-year-old. And they're going to rate you at 55 with your medical ailments if you have those now, not as that vibrant 25-year-old that was looking a certain way. No, they're going to rate you differently. So the premium could change. Difference is with a whole life policy is that whatever that policy is, whatever the premium is, it's going to stay that forever. Now, the difference also, Kristen, I want you to explain this to them as well. Now, you might buy a $100,000 term life policy that costs you $40, but you can probably buy young $150,000 policy for the same $40, right? But what's the difference?
The difference is this. So you're young, less risk. That's why it doesn't cost as much when you're young. The problem that people experience is as soon as they get into financial trouble, they want to cash out that whole life policy, use that cash value to get them out of trouble. The problem with that is you're never going to get that premium and you're never going to get that policy back, and you're never going to be any healthier than you are when you got it.
Absolutely. Okay. I never thought about it like that. That's good. That's good. So that's good. So let's talk a little bit more about that index universal life policy, if you don't mind. You said it can, if it's funded properly. Explain the funded properly. Well, not too deep, because you confuse me sometimes when you talk about it. But talk about give us an example of how our index universal life policy works.
All right. So most people think indexed universal life is bad. The problem is that you've probably dealt with somebody who only funds it so that the policy will stay in force, meaning you're not using the product properly. Okay. How we structure our products is we overfund them because they have some really great kept secrets called compound interest. So for instance, if you were to fund an IRA, we all know that IRA is only going to grow at probably 2.5%, and it's taxed when you take it out on the capital gains. It is what it is. And you can only put in so much based on either being a single person or being a married person. And I believe the max is $6,500 per household.
That's it.
Okay. So with that being said, if you are going to fund an IRA, you might want to look at an indexed universal life, because for the same money, you could be getting 6 to 7% compound interest. You can be getting a death benefit.
Yeah.
And you can be getting living benefits all in the same product.
And you're not limited. And you're not limited to $6,500 either. Right?
No, you're not. No, you're not. But sorry,
I was
guys.
like, what? I thought my beard touched the microphone. I'm like, did my beard grip me? I know I tried. Like, where did noise come from? Yeah, she breeds. She breeds like champion Labradors, right?
You got it. You got it. And you let a ring go off in this house, and you know somebody's in my house. So
Yeah, yeah, yeah,
um,
yeah.
so sorry about that, guys. But you know, that's the beauty too of being able to you know, work from home and not have to work for someone else. So
Absolutely.
with that being said, so what can happen with those policies is, again, like you said, you've got where you don't have a maximum amount that you can put in. If we structure it properly, you can grow with your job long term. So say you can only put in $300, you know, the first 5 years, but then after 5 years, you know, you're going to get a raise or you're going to move up at your company. Now you can actually put in $600. If we structure the product properly, we can supplement Social Security if it's even there when you know, when you get ready to retire. If you're paying into your 401k more than 3% and your company's only matching 3%, you're going to want to use those funds as well to kind of supplement this as a retirement plan, because what's going on here is what we're doing is we're creating a tax-free environment for you that you can't create anywhere else. We still good? Looks like everything's blacked out here.
Chris, are you there?
I'm here.
All right. I mean, I don't know what happened right then. I think it was something with StreamYard. But I heard last thing I heard you say, if you were structuring a certain amount, we said if we put $600 in, then it kind of went away.
Yeah. So for instance, say you have a 401k at work. Here's where I talk to people about how to structure a indexed universal life product properly. So say I have a 401k at work and I'm putting in $150 biweekly. And
Mhm.
let's just say that that's 6% of my income, but my company's only matching 3%. Well, essentially, you're putting in 3% that you're really only going to get 1.5% on, because you have to pay the taxes on anything that's above the 3% match. So if your company matches 3%, you should put in 3%, because I call that free money, because essentially your company's paying for your taxes.
Mhm.
That's all they're doing.
Mhm.
You're putting
Gotcha.
in more than the 3%, you need to stop, because you got to give that back to the government. You'd be
Absolutely.
better off taking that extra money that you're overfunding your 401k with and put it into an indexed universal life product, because here's what happens. It's compounding interest. You
Mhm.
don't have the up and down with the market that you have with a 401k.
Mhm.
And when you get ready to retire, you loan the money back to yourself. And if you know anything about loans, you don't pay taxes on a loan. So you're essentially creating a banking system for yourself.
Absolutely. It's some of the illustrations that I've seen have been, I mean, just crazy. I mean, people don't know that whole concept of $1 million baby. If you
It
take
exists.
if you take a child at a certain age and start investing in life insurance for that child, when that child retires, he or she can literally have $1 million sitting there, and it's tax free. It's safe from probate, and you can use it it has a death benefit, a major death benefit, and you can live off of it, like you said, through policy loans. And even while you're taking out the policy loans, the death benefit is still there. So it's made that, and that's why you take out the policy loans. That's why
Yep.
you don't take a lump sum, because you want to keep the account value at a certain I guess I did learn something, didn't I, Chris? I was paying attention. I don't know what's going on with me.
And,
So
and
that's
don't forget, you get the living benefits with the chronic, critical, and terminal illness, and you don't have that with a 401k. You don't have a
okay.
death benefit. You got a death benefit. Like if you die, they get what's in the account. That's it.
Okay. Gotcha. And so, and also with a 401k, the debtors, the creditors and debtors can get that first, right?
Yes.
If you pass away,
Yes.
but they can't with life insurance at all.
Nope.
So the 401k is susceptible to taxation. It's subject to the credit man. It's subject to the probate, everything else. But
And the
life
market.
insurance. Yeah, and
and
the
the
market,
market.
because the market goes up, and we know it corrects itself. Don't get us wrong, but with indexing, we're safer because we get to participate in the gains, but we don't have to participate in the losses.
That's
Correct?
correct.
Yeah.
Yep.
So when the market loses, you don't lose, but when
Mhm.
the market wins, you win. And so on average, it typically pays somewhere between 4 and 7%. If and that's a retirement tool. That's another
Mhm.
insurance product that does not have to only pay when you pass away.
Yep.
It's an insurance policy that you can use to help you through retirement. So let's talk finally about whole life.
Okay.
It's a whole life is usually a product that we call final expense. Correct?
Yep. That's
Now,
correct.
how does that work?
Guaranteed to pay out when you die. The same
Okay.
as like the guarantees with our life is that we will pay taxes and that we
Hmm.
will die.
Okay. Okay.
2
Yeah. And if you avoid
guarantees
long
in
enough,
life.
you go accelerate that. Yeah, that's true. So now do and I heard this before. I don't know if it's true or not. Do excuse me, final expense policies pay faster than term policies?
That I think that's a myth because
Okay.
there's a couple of things that confuse people. So every insurance product that is purchased in the entire United States has a contestability period. It doesn't
Okay.
matter if it's permanent or temporary.
Okay.
What that means is this. The insurance carrier has the right to look back on the information on the application to make sure that the client did not hide or lie on their application. So there's a 2-year period or look back period to make sure that they told us the truth
2 years from the time of death,
from the time that they signed the application.
or from the time of death. So
Mhm.
after 2 years,
Mhm.
then there's no contestability period anymore. So
Nope.
they pay automatic, unless it's like a
Mhm.
$500,000 policy or something like that, or does it really
No.
matter?
No. It doesn't matter. But I tell people this all the time. The reason I talk to about contestability period and
Hmm.
wait period because I think it really confuses clients.
Okay.
And most of these contestability periods, it doesn't matter what type of insurance policy you buy, as long as you tell the truth on your application, they will pay out the policy. The problem is that people who are sick know that they can't get coverage and they try to buck the system.
Okay.
That's why we have so many disgruntled people about saying, well, the company didn't pay. Well, there's probably a good reason the company did not pay.
Now, is there a difference between the contestability period and the elimination period?
You mean a wait period?
Yeah, man, that's what I mean. Wait period. Yeah.
There is because normally you wouldn't write a guaranteed issue product,
Hmm.
meaning that the client has to wait 2 years for the policy to pay out because the client's telling you that they're already sick. So a guaranteed issue product does not have any medical questions at all. It is what it is. It's guaranteed issue. If you die of an accident, it will pay out day one. But if you have to wait for a health condition, you have to wait 24 months and 1 day.
Okay. Yeah, I sold one of those. I sold one of those recently, and I was amazed because there weren't any questions. I mean, there were any
Yep.
health questions. There just was basically get their checking account information and go to work. I mean, and they understood that because that person
Right.
had passed away and came back to life. Honestly, she had a heart attack and almost passed away. So but we're able to offer her something, and that's the good thing about it. And
Yes.
if she does make it those 2 years,
Yes.
then she will have coverage, and that's
Absolutely.
that. And I'm glad
Absolutely.
we're able to cover her and help her through her time, rough time. So let me ask you a question: why should we have permanent insurance, and what is the cost?
So permanent insurance pays out guaranteed payout at death.
Hmm.
And what is the cost? Here's the cost. If you don't do it, then somebody else has to do it for you, which is a burden. If you
Yeah.
do it, depending upon how much coverage that you want, is going to depend on the cost.
Okay.
And that's why I always tell people after you're 50, you should be looking at permanent coverage.
And as close to 50 as possible,
Hmm.
because I mean, it's amazing now how I have people. they're 50 and 60 and they're calling for insurance for their mother and father,
You know.
and their mother's 75, 80 years old,
Mhm,
and all of a sudden now they need a policy, and it's $250, $300 a month, you
mhm,
know, and they're wrestling with, should I pay $300 a month, thinking that she might not live, for
mhm,
pay for $10,000 policy,
mhm,
but she might live 5 years, and I'll overpay the policy. I'll pay
mhm.
more than. So that's a tough one. So the safest thing to do is to make sure that you're covered at the as close to 50 with, at least with permanent insurance.
Correct.
Temporary insurance while you're young,
Mhm.
but as you get a little bit older, making sure around that 50 age, you need to make sure you have something permanent in place. Do you ever recommend a time to get permanent insurance prior to the age
Yep.
of
I
50?
call it stacking your insurance. It's what I did.
Okay.
So I
And you
have
said
both. I got term and permanent in my
okay,
40s.
in your 40s. So while it was still affordable, instead instead of waiting until you, like I said, because if you wait until you're 55, 60,
Mhm.
now you go and try to purchase a whole life, it's going to be a lot more expensive. It's going to be $70, $80 a month, and you're not going to get as much benefit for me, well, policy
Mhm.
amount. But if you do it while you're young, folks, I have people now that are doing paid up policies for their children. I mean,
Mhm.
they have 7-year plans that they can pay for their children, and the policy is paid off. That's a gift you can give your baby. The $25,000 policy that is sitting there that's paid for.
Yep.
But or else you can pay up to 100. But you need more coverage for your children. We can definitely help you with that. We can definitely help you with it. I have a friend. She was on with me last night. She insured her 3 children. I think 26, 21, and 19. She got all 3 of them at least $50,000 worth of coverage, and I think she didn't pay any more than $50 for all 3 of them. And that's if something happened. That's what it's for. It's
Mhm.
in place in case an emergency happens, in case something happens, and you don't want to have to pay that out of your pocket. You're not. It's not that we don't. We're not. We shouldn't depend on GoFundMe. And that is so powerful. What you said, your client said yesterday. I don't want nobody parading me on Facebook. Let me die in
I
dignity.
almost jumped up and hugged the man. I was like, "Oh my gosh, somebody gets
Yeah,
it."
I mean, and I guess that's a way of saying I'm dying with dignity. I'm going to make sure that I've set my affairs before I left and got out of here. And you can do that while you're young. I mean, because some of us pay $250, $300 a month for cell phones. We pay all kind of money for hair and haircuts and all this kind of stuff. I pay nails and everything. I ain't trying to point the finger at nobody, but I mean, I pay $150 a month for haircuts. You know what I'm saying? And I got babies. And I got
Right?
to make sure that if something were to happen, well, they're not babies anymore, they're grown. But if something were to happen,
Yep.
they are covered.
Yeah.
They're covered. They'll get a lump sum, and that lump sum is going to help them for a period, at least for a time, to help them get through for a few years, at least pay the rent up for 2 or 3 years, or pay a car off, or do something that's going to eliminate debt and make life easier for them. So,
Mhm.
and also they're going to be able to bury me. And
Mhm.
that's the goal. That's
I
the
mean,
goal.
here's what we talk about. You always want to leave somebody better than you found them. We're
Okay.
not trying to, I mean, granted, we get a commission for writing a policy, but we're not trying to get rich.
Yeah.
We just want you to be taken care of. And honestly, I live and die by this. And I live and die by it because I think it's important. I don't care how much coverage you get because I believe that something is better than nothing.
Yeah. I'm learning that when I was watching some of the classes, I mean some of the trainings, how they were just setting people up just to make sure that if Mr. Bob died, that they could, the mortgage was $500 a month, and then they could go 500 times 12. What's that? 60,000. They made sure they put $60,000 in place just to get them through that time. Just a period of time, and you got, and that's smart, just to make sure they have something. So, Chris, I appreciate you. I'm not gonna hold you any longer. It looks like our time has expired, but people will catch the replay. People will catch the replay, and I think we have a better understanding of what term life is and what permanent is. Term life is going to, excuse me, temporary is you're going to be your term life, and you need to get that while you're young, while you have the most debt. We're recapping right now. While you have the most debt, while you have the most debt, and whole life is going to take you on over make sure that your family is coming, that your burial is covered, and then you have an index universal life that you can use as a retirement tool. And that's, I mean, for those of you all that have 401k, you putting 7% in your 401k because they're allowing you to. You think they're smart, but they're only matching 3. You might well take that other 4%, put it in the index universal life, and get some money that you can see, because you're not going to see any of that. That money's going to the government. Government's gonna hit you, and people don't even realize that. They don't even understand, if your tax deferred is not tax delayed. I mean, tax delayed is not tax deferred. You're going to pay taxes at some point, and usually taxes aren't going down. Taxes are going up. So if you don't pay it to you're 59 and a half, and that's 25 years from now, we might be a 60% tax bracket by then, and they're going to hit your 401k first. So take that extra money and invest it in an index universal life, and I can help you with that. Chris can help you with that. So y'all, if you need any type of life insurance, if you need whole life, you need term life, if you need it, reach out to me, let me know, and I will definitely make sure that we can get you and your family protected. Chris, I appreciate you.
Appreciate you, my friend.
And we'll come on again probably the next 2 or 3 weeks, and we'll talk a little bit more. Maybe we'll talk a little bit more in depth about Index Universal Life, so we can show you all how to use it as a retirement tool. Okay. So I always ask the same question every time we get off the show. So I'm going to ask it again. The world is changing. My question to you is, why do you remain the same? Y'all have a good day.